Arey, wow. Okay, we are going to start. This is a completely random space because
Ran-
uh,
Random space to celebrate the random search, random rally.
random rallies and random short covering or whatever you want to call this complete crazy thing, which seems to happen altogether too many times in markets. But we were talking about it today, saying ये क्या हो रहा है and क्यों हो रहा है and why and what and all that. But I'm not going to talk too much because I don't know why the market has gone up, to be honest, and I don't know why world markets are going up. I don't know why Credit Suisse is going up, and why pension funds in the UK are still hobbling around, are not hobbling around trying to find an exit for whatever they've done. But apparently, everything has suddenly turned turtle. So I'm going to ask anybody who wants to speak to raise hands and talk, because I think some interesting things have happened. So please, request to speak, and Nihit and I will add you as a speaker. If Twitter behaves, sometimes it refuses to behave, and you know we don't see any uh, uh, requests, but people tell me later that they had requested. So, quick interesting point was, I think last month we had some 16 to 18,000 crores of um, selling by FIs, and to a large extent they've kind of negated what they did in August, which was, I think, bought roughly say 18 20,000 crores of equity. So they're net neutral after that. But these numbers are huge because we're talking 18 20,000 crores a month uh, of net buying, which is fairly huge from all perspectives. So the activity levels have gone up, but at the same time, retail activity also seems to be quite large. I don't know what the numbers are for September in terms of domestic mutual fund investments by retail investors. So how many investors invest, how much investors invested in equity versus ETFs and so on. But it seems like quite a bit of investments have come. So possibly one part of what this market has done in the last maybe uh, in the last few weeks has reflected a little bit of domestic sentiment coming in. Remember, 18 the 20,000 crores of exit from FIs, the markets are down only what 3%. So it's not even like a big blip. You kind of made that up in a day, almost what 2 point something percent today, and possibly if the U.S. markets are right, we should probably see as much of a move in the next trading day, which is going to be Thursday. So in advance, wish you all a happy Dasera, and uh, lots of interesting stuff happening in the markets also. The good, I guess, is triumphing over the evil. So that's the theme for Dasera anyway. So let's get some questions in. I would love to
Yep.
hear people's thoughts on why the market has gone.
Right.
What should you do? I don't have too much to say in terms of advice, but if people have any questions, please go ahead. Go ahead. Get a request in.
Right. So Deepak, we have a request from Sandeep, so I'm just putting him on. Sandeep, you could unmute yourself and uh, ask your question.
Sandeep, can you hear us?
Hey, hi, Deepak. Thanks. Thanks for this random space. I guess everybody's grappling through this. I had a comment slash a question about the texture of the market in terms of number of investors slash traders increasing dramatically, and hence the time frame of large number of participants reducing, thereby giving very sharp large moves intermediately, given everybody's on same side. If we go through say Twitter trainers, almost everybody teaches same thing: go long if this happens, go short if this happens. How much, in your view, is contributing to actually um, these kind of moves, and does does the rally will sustain from here, given um, uh, if this understanding is true? Second, about the decoupling, not just in terms of market in India performing better, but in terms of economical factors, the large touch and feel factors in India are substantially more positive than Europe and US and other places. Uh, most of the quarterly updates which has come till now are extremely positive, be it auto numbers, be it numbers from the banking sector. So does that have enough tailwind in your way you look at the markets for this to actually sustain and take us further? And even if in November the Fed was to come back and hike rates and create another hawkish stance, whether we can survive going down from here. Uh, what is your take on those factors?
Okay, let me try to take the first one. I think the first one was about number of retail investors increasing short-term positions. That's been the case for a very long time. In fact, if anything, a lot of short-term leveraged positions have actually come down because of SEBI. What earlier used to happen was you get 100x leverage. You no longer get that because SEBI's clamped down on how much leverage can be offered. They've introduced peak margins, which means you have to have enough margins at the beginning of the day and now at sometime before you take the position. When you cannot even rotate your money into taking on more and more positions intraday without actually having the capital to back it up right up front. And uh, to a certain extent, even margin requirements have gone up quite substantially. Having said all of this, these things were much higher. I mean, the intraday leverage based trading were much higher in 2006, 2007 than they are today. Of course, options markets have blown up, exploded since then. Not blown up, but exploded since then. So, a lot more people trading options, but mostly Nifty options. So, you see, stock options are relatively small. Nifty options are the biggest play on the planet. It's also a very interesting way that more people are getting involved in the markets probably from the beginning in Nifty options themselves. So I think maybe it does play a part, but how much does it play a part in terms of controlling the market change? I don't know. I mean, I believe here there's also been a lot of algorithm based trading, but again, does this affect the valuation of individual stocks? Does it explain the fact that the mid caps, which a large amount of them don't even have futures and options on them, they don't. They are the ones that are performing really well. In a market where otherwise you would think only the positions which have derivative positions or stocks in the Nifty will be the only ones performing. If they were the ones being let's say manipulated or talked about or whatever it is in these retail trader offerings. So I don't think this plays the only role. There's probably a lot more at play. There's the EPFO getting in. They buy, of course, only the Nifty and Sensex ETFs right now, and some public sector ETFs. So they've probably upped their game. A number of other funds have also started to invest more and more in equities. There's some more. There's individuals who increase their allocation to equities. So a lot more individual investors seem to be coming in. Though they even today, I think the largest investor in the markets is still individual. So maybe that has more to play than the recommendation based thing. The second question was what happens now. I guess you said about the U.S. Fed raising rates and us relatively becoming our will India be able to take another downturn? I don't think we have had a downturn of any meaningful sort. We've had about a 15-16% drop from the top. Um, Again, which is not so bad. 15-16% anybody should be able to take, whereas the US has fallen substantially more. So I think there the markets are reacting violently from a fairly sharp move down of 23-24%. We, on the other hand, are only about 8 or 9% from the top now, probably even lesser. So for whatever it is, when there's liquidity that returns to markets, India will benefit because India will get these tiny allocations of all liquidity. And this was when I said this in 2020 also, when there was this massive push by the Fed to print $5 trillion to energize the economies. I said we'll get a million, we'll get 1% of that, which was 50 billion. And within the next 2 months, there was massive investments in Reliance by all of these companies. There was massive investment. So they did invest 200 to 300,000 crores in India. That was at that time roughly 40 billion or so. Uh, any liquidity that comes in worldwide, I think about 1% of that will flow to India. So if there is a feeling that liquidity will come back, I think that is driving some enthusiasm in markets. But if the liquidity is taken away, there will be some liquidity outflow from India as well. But that seems to be countered by whatever is happening with domestic investors who seem to be piling on whenever uh, foreign investors seem to be leaving. So I don't know how long that can continue. I mean, we do have a lot of people with a lot of money, but at some point in time, you keep wondering whether, um, is this a market that's just simply always going to go up because people are just going to invest and so on. But I don't know. I mean, the answer to this is there will be a point at which that liquidity, if interest rates are raised further in the US and perhaps in India as well, the lack of liquidity will start to hurt us, and our markets will also, hurt equally. But I don't like to predict. So if you had asked me a year ago, all these things would happen and India market would be only down 6 or 8%, I would have laughed at you. And yet today here we are. So don't know the answer to whether we will go down. I just feel that there are forces here that seem to be defying logic in a lot of ways.
Uh,
Thanks, Deepak. I guess there is no right or wrong answer for this. This is, but appreciate your views. Thanks.
So, folks, we have our lines open. So, anybody who would want to ask or comment, you could just request and we'll put you on. So, before somebody does that, Deepak, I have a question. Recently, in our universe, that is the universe of Twitter, where we get all our news and comments from, I'm seeing a lot of people turning quite bullish on India's story and India for the next decade. And as I recall, I've been seeing this only very recently, and it coincides with the worries that the West and US has. So have you also turned bullish on the India story? And no, I understand you are always bullish, but do you think this is something? Is this an inflection point where India is poised to do something good, something better than the other markets? Are there any triggers? Are there any levers?
So, Neet, I think definitely, we do have we have a lot of things going in our favor. For one, our GDP is, even with all this drama, the RBI's latest monetary policy talked about how much the Indian economy will is likely to grow. They said it will grow 7% in Q2, which just got over. Q3 and Q4 are going to be relatively benign at 4.5, 4.6. This is real rates, okay? And inflation still at 7%. So if you add 7% to this, you're actually growing double digit nominal for this year. The US may also grow double digit nominal, but that's because they have very high inflation, but their real growth is actually negative. So, in that context, India is doing fairly well. Even otherwise, if you don't consider that, one of the things that India has always been is there have been two parts of India. I think there's always the financialized part of India, which is the top 100, top 200, top 1,000 companies, which are all the listed space. And then everybody else, which is the unorganized or semi organized or relatively low capital or capital constrained space, because they don't have access to capital markets, they keep their they have money in they have money in real estate or gold and don't have it in financial assets and so on. This is the second part of India that's kind of turning into the first part of India slowly over time. So it's like companies getting into GST simply because the GST offers them much more advantages than not being in GST. So they financialize, they get into the formal part of the ecosystem simply as part of it. This has been a process that's been happening over 5 years and slowly. And so this time when they announced numbers, they were talking of 147,000 crores in GST collections this month. Now, this particular month is probably very interesting because this is probably the first, September is probably the first month when you can say that 2021 was post lockdown. So most of the lockdowns in 2021 continued till at least June. In some states, even beyond that. And it's only by end of August that even schools were allowed to be reopened in most places. So you end up with a situation where September is probably the only month when you actually had some kind of a recovery, and then October onwards things were much better. So we, even then we're looking at a 26% year on year growth in GST collections. There is the other parts which are our financial system is much better now because you have UPI, which is growing leaps and bounds. Um, there is the stock and mutual fund and bond markets, which have become more accessible to almost all investors. There is this feeling that, well, there's a part of India that's still emerging, in the sense of it's still got a long way to go. Uh, this having been said, it still doesn't mean that we are immune to a crisis. All markets run on is liquidity. If liquidity vanishes from any ways, and it could be, the an upcoming, let us say, there's a bust in a bunch of startups and IT companies stop hiring, and the people in this space are the ones that perhaps have provided a large amount of liquidity to markets by setting up SIPs and growing and things like that. That drop in that liquidity itself could cause a change in markets. But I mean, unless something of an event of that magnitude happens, it seems the momentum itself of the growth of financialization, of the growth of formalization of this economy itself seems to be more attractive compared to the West. So it's like if you were more formalized, today you would actually be suffering because our bond yields going up, which they have in the last few years, will actually hurt a lot of our industries. Today our industries there are so few industries that even access the market using bonds, that you end up with a substantially small part of the economy that's even affected by the bond market yields in the first place. In the US, even small companies can access bond markets, so they are the ones who get affected more and more. Well, interesting dichotomy there. So you might have one place where a bond market investor looks at, like in India, a bond market looks, a company looks at the bond market and says, "Oh my God, I can raise money at only 9%, whereas I only get 15% from the banks." Whereas, in the US, the bond market is the best place for companies to raise capital. So they almost always get roughly the same rates, or it's a very competitive system where you get rates that are very competitive in both the bond markets and in the and by direct financing from banks. So uh, you know maybe that's the reason for the enthusiasm about India. I don't know. It's a very good question to ask about why India is more attractive, or India sounds attractive. It's and I keep saying this. I know it's a broken record, but we've done all the mistakes that the West seems to be doing now. We've tried to uh, beat inflation by giving our people money. We have tried to give people money for free without working We have tried to not rescue, I mean, tried to let our banks get over leveraged and have too many NPAs without actually trying to fix the system. We have done crazy stuff like ignoring inflation until it was too big to be ignored. All of the stuff that the West is doing now, we've done it in the recent past. We've learned our lesson. So in a way, we didn't do those stupid things in the recent past, which is why our inflation is relatively low, and we may not have to relatively hike as much. But at the same time, we're still a closed economy. We don't allow foreign investment as easily as many of the other countries do. So, uh, in that context, our recovery may not be as fast as one thinks as well, but it might just insulate us from the extreme damage of the West.
Yep. So that helps. Anybody else would have any questions? They could just unmute themselves and ask away.
Yeah, questions,
Nitya,
comments.
if Nitya, if you don't mind, can I ask one more?
Oh, yes, go for it, man. There's nobody else. So, you're the guy.
Great. Deepak, I also wanted your house view or view on the debt side, and specifically the question on that is whether this is a time to start increasing the duration of the debt portfolio. Just as a background, I am though trade equities FNO very actively, but my portfolio is 80% debt, and I have been reducing the duration for almost 3 years now. And do you think it is a good time to start now stabilizing that or increasing that, or I should continue to reduce the duration for some more time before I pivot?
So, quick answer to that is, I mean, there's no easy answer to this, but I think duration should be reduced only when it is evident that the RBI will stop increasing rates. Increasing durations means that you're actually increasing your sensitivity to any potential rate hikes. And even though the RBI was, not as hawkish as we thought, they aren't actually moving to a point where they're saying we're going to cut rates. Nobody is. So until they end, because the RBI acts in the way it does, it will never hike rates and then suddenly cut rates unless there's massive deflation or massive change in the economy. So what is the normal course of action is they will raise rates, they will see that the economy is kind of, let us say, slowing down and inflation is under control. And that's when they will say, okay, we will pause. Once they say they pause, they're going to wait for at least, they are going to wait at least a couple months or a couple meetings before they say, well, it's time to cut rates. This is just how RBI operates. And in fact, if you were them, that's what you'd do, right? Unless there's a crisis situation, you'd say, let's not hike once. They have not hiked at all since May. They met in May, surprise meeting. They met in June. They met in July and or August, early August and end September. All of the four times they've hiked 50 basis points. So there is there is a tremendous push upwards right now. I think raising duration of your portfolio means you will you if you've brought it down over the last few years, you're actually getting as much as a 30-year bond is if you're at least 2 years in duration. That means whatever is beyond 2 years is earning about 7.3, 7.4, 7.3%. And what is 20, 30 years is also earning 7.3%. So the yield curve is flat. So if you're not getting any premium for duration, why bother going there right now? Especially when you don't know whether the RBI has decided to move or not. Once they make the noises that say, "Well, we're going to pause," or if they actually pause, that's when you might want to bring duration down. It's a very slow thing, so I think predicting it is not useful. And even if they do start going down, it will take a lot of time before rates actually go downwards meaningfully. So you'll have enough time. You may miss the first 10%. I just say that. Hope that
Yeah,
helps.
okay. I think so. I have operated that way. Anyway, my portfolio is not a MTM based, but accrual based, and it doesn't. So just historically, I had debt instruments which are maturing now, yielding 9-10% to me, and my reduction of duration was simply replacement of the maturities by very low tenor instruments, and it is not any radical going and selling and actually buying something low, because it is essentially an accrual portfolio, and I'm not that sensitive to MTM, also because 100% of the portfolio is either AAA rated or bank instruments. So then the last follow up question after that, I think so others can come up, is how your views are on allocation between debt and equity based on the rate. So historically, Indian bonds, 10-year bonds at 8%, have been at a good rate. So when interest rates are rising in current environment, or they're looking to
Sorry, I
be
had a
raised
question
by.
for Deepak. Is everybody quiet or I don't understand?
Uh, Viraj, no, we are speaking. So Sandeep was asking a question.
So my question was how to set the allocation between equity and debt based on the level of rates. Do you have a study, or do you think that is even a good metrics to look at, switching between debt and equity based on the, let's say, a 10-year India bond?
God,
Uh,
God. Okay, so I don't think there's a study because we don't have meaningful pass. Every cycle in the debt industry will be 3 to 4 years at least. Okay, so if you look at the cycle that we've actually had a reasonable 10-year trading, uh, and when even before 2020, what was called repo is now reverse repo. What was called reverse repo is now repo. So that terminology itself was all bad. So our debt markets are relatively new. So you have like 20 years of history. So very difficult to extrapolate or create a basis based on trends that perhaps have been lasted. And you're in unprecedented territory. You've had the world's greatest macroeconomic experiment. You're seeing India. I don't know whether it's decoupled or whatever, but there is a significantly different reaction in India compared to the West in equity markets, also in bond markets. The bond markets in the West are seeing long yields go up. We are seeing long yields stay stable and short yields go up quite tremendously. So they have inverted yield curves. We have a flat but not inverted yield curve. So I don't think I'd make a wager across the world saying, this is what your debt and equity allocation should be. I think people should take debt and equity allocations based on their own liquidity requirements and their risk taking ability. So if you feel jittery about losing 30%, then go to 60% equity, 40% debt, and then you lose only 20% or 17% on your overall portfolio. So because markets are going to correct 30% whether you like it or not. It's just that they haven't in the last 2 years. In fact, only in the last 2 years. Because in the last 3 years, they've definitely corrected 30%. So I would say no universal debt equity allocation ratios at this point. I know that other people may have it because you can use P ratios and all that, but I'm not. I'm not a big. I don't have one personally.
Thanks for all the clarifications, Deepak. All from my side. Thanks.
Thanks,
Thanks, Sandeep.
Sandeep.
Viraj, you may please mute yourself and ask a question.
Hi, thanks, Deepak, as always. Deepak, what I wanted to understand is if you look at the real estate market, which probably started doing very well after 6, 7, 8 years of hiatus, was aided by large salary jumps in the formal sector in last 2 years. larger savings because people's propensity to spend was curtailed because of lack of movement, and very low interest rates. A lot of these factors are now actually turning around, and the prices of real estate have also moved up. So, do you think that this sector, which essentially is the backbone of a lot of other sectors and the economy in general, will not see the expected, longer run growth?
A great question, Viraj. I think uh, we have a we have a very interesting view. I mean, in the sense that prices in India are very local in real estate, so they don't seem to have a global view. Um uh, in as in low real estate in Bangalore may be going up while real estate in Delhi is going down and so on. But if you ask anybody, and I get 5 calls a day now on real estate also, they only seem to say, "Sir, you don't buy now, your prices will go up by tomorrow or whatever." So, which is very strange to me. And in fact, I haven't got these calls for a while. But at the same time, cost of construction has also gone up. So what used to be a 800 rupee, 900 rupee thing about a decade back in terms of core construction is now above 1,800 to 2,000 rupees per square foot for a lot of apartments, and higher end, of course, it keeps going increasing. So, and the cost of land has also gone up, cost of acquisition and retail. Now, with real estate mortgage rates going up, your EMIs would have also gone up. So if roughly 25 to 30% higher EMIs for the same priced house, for the same tenure, is what is happening right now. Is also another part of this, which is the financialization. So people who used to invest in real estate are probably not doing so as much as they were earlier, because if you own one house, that's great, but should I own two, three, four houses? That part was easily answered if you were, um, earlier it was always like, huh, ek to you have, and then you should have another one and all that. Now I hear a lot of people saying, boss, one is enough. In fact, they have the second one, they're trying to sell that, put that money into stocks, which are easily sellable and then sellable in part also. आप घर का एक bathroom तो नहीं बेच सकते types. So, that way you have this dichotomy of real estate, which should be doing well in a good economy, but because of people's moving to financialization, doesn't. But also that real estate interest rates might drive down some of the otherwise this in demand. I don't know. Of course, I have to revalidate. Uh, and you're the boss here, but is Bombay real estate actually correcting? Does it ever correct? Is there such a thing like that at all?
Prices
And
don't, but volumes fall, right? I mean, they have not fallen yet, but and in
oh,
Bombay, the prices also there are like headline prices don't correct, but there are enough deals you get. I mean, but so I mean, the only idea was to understand the kind of registrations we have seen over last 2 years have been phenomenal, right? And not only in metro cities, yeah, even you look at data for Indore, Jabalpur, Ranchi, Ahmedabad, Rajkot, Baroda. So we kind of track this, and they've just gone through the roof. They're like more than 2x up from their 19 numbers. We just don't know
wow.
whether these are sustainable.
I agree with you that it is probably not. And I think one of the reasons that they were sustainable at the time, or they sounded very big at the time, was because you had these lockdowns where you couldn't spend your money at all. I mean, holiday पे नहीं जा सकते, restaurant नहीं जा सकते, you can't go anywhere, you can't see a movie in a hall because the halls are closed. You have this excess money lying around. What happens? The typical uh, affluent Indian situation is, if you have a lot of money lying in the bank account, the first thing you hear is, what do I do with that money? Oh, go buy a house. So you go book a house, and then you say, "Oh, I don't have to pay the whole thing right now. I pay a certain amount. I take a loan for the rest." So you immediately kind of get yourself on the bandwagon. So now that we're unlocking, there's things to do. The things to do are expensive, uh, because travel has become expensive. I don't know if movies have become expensive, but I'm assuming the popcorn's more expensive than it was 3 years ago. As also, hotels have become expensive, um, and you can do the things that your income was not being used for 3 years ago. Plus, perhaps there is a crunch on income growth as well, because that part has at least sorted itself out. So, given this, I would say we're in a situation where things look a little more iffy, perhaps on growth of the past extrapolated to the future. But perhaps there is a natural growth to real estate depending on location
Sure,
that will still
sure.
continue. Yeah. And
And just last question, right? So if you look at especially last 1 year and last 6 8 months, um, a lot of so essentially in India you have commodity producers and commodity users. So a lot of companies, obviously, who do not have pricing power like HUL and others, were basically suffering because of very high prices of commodity, and basic chemical manufacturers were making absolute merry. Like if you look at people who were manufacturing alkalis or phenol and like absolute basic chemicals, or spreads of GRMs of refineries were going through the roof. So basically, basic material were making a killing in last 9 months. Do you see that now that the spreads have come down, alkali spreads have come down, GRMs have come down, agro commodities have come down? Do you see that trend reversing and staying here for some time, and thus benefiting the actual, I would say, reasonable companies who are doing and converting some of those things into semi brands, as I would call it?
oh yeah, I mean, I think this is quite interesting because if you look at so for instance, if cement prices go up, construction costs go up, it hurts the guys who construct stuff, so who can't pass on their prices perhaps. So at this point, you might see a margin expansion at the end user level, for the short term. But what happens when prices of commodities come down is some of these producers of commodities have actually become inefficient because it was so easy to earn money. Your relatively your commodity price is going up, but your cost of production is not going up so much. So relatively speaking, they, even if they push their costs up by doing something really inefficient, they didn't bother too much about it. So over time, if you have a 2 year period like this, which is like a great love phase, you end up with a lot of inefficiency. So your margins are big, but they're not as big as they could be if you were efficient. And some of that inefficiency, I'll give you an example. Even some part of IT is a commodity. There is a part of
Right.
IT that can be automated, right? So you can automate it. But if you're getting labor for a certain cost, and but you're able to cut off your substantial amount of your costs of travel, of even office space and maintenance and all that stuff by having people work from home, you're actually you don't care quite as much about, say, automating tasks or investing in certain automatable efficiencies, and therefore what happens then is, even if you start to hire people at a much higher salary base than you could otherwise afford, you hired them anyways. You said, okay, I want them on the bench, I want to put hiring letters on. When times come like today, the same companies are saying we will not honor these hiring letters because nahi dena hai salary, I don't want so many people on my roles. I'm actually cutting off bonuses so that people who are with me also will actually resign, so that I can get rid of the excess that I had built, because your inefficiencies have crept into the system. So you could find the same in almost all commodity providers also, where they'll have to start getting more efficient. So they will see their margins crunch because they can't control end prices too much. The consumers of those products, the commodity products itself, might see margin expansions because they they get a higher price from the end user due to expected or whatever realized inflation in their prices, and their demand hasn't yet gone down quite considerably, so they are not seeing demand pressures that will cause them to cut their prices. So they will benefit. So one, for instance, in Asian Paints makes paints, input is crude prices have gone down, they benefit, their margins expand now. But at some point when all paint companies start seeing declining demand because of, and you'll have to change that using price, they'll have to take price cuts, and when those price cuts happen, margins will come down to more reasonable levels. So you might see margin expansions there, I think. But you know, uh, unfortunately, in the commodity world, a lot of times prices coming down cause companies to actually take debt and lever themselves, which is why a lot of steel companies in India were are ended up being in a mess because they would always lever themselves in a steel downturn, and the steel downturn would kill them, kill a lot of these companies simply because they had too much of a debt burden that they can never get out of. Having said, I mean, I hope that doesn't happen. I hope that doesn't happen a second time because we already had it in the past. But that's the risk on the commodity side, that you'll end up with companies with too much debt.
Right. Thank you. Yeah. Thank you so much.
Thanks, Viraj bhai. Thanks, and we'll get Sahil in. Sahil bhai, your next comments, thoughts, questions.
Hi, Deepak sir. Hope you're doing well. Uh, my first question is I have read a little bit about this bond index inclusion, debt bond index inclusion. So, can you please talk about concretely, in an economic sense, how that helps India, like the small companies and so forth, and also like potentially can this unlock faster growth for India? Like, what are the implications of this, and also what is keeping us from being included? Because we keep hearing about this year after year, but it's not happening.
Yeah, this is like a little bit of a pipe dream that I keep hearing every day, every year. So I'm going to be very skeptical on this, okay? Because this is okay. Let me give you the basis of what I think is the problem, and the problem, or the concept. The concept is India. The government of India issues bonds. The government of India issues bonds mostly in Indian rupees. We don't tend to issue bonds in US dollars. We don't like to, and we don't perhaps need to. But what happens when you issue bonds in the local currency is that you have to allow foreigners to buy them if they want to participate in local currency. But we always had huge restrictions on foreigners buying our bonds because we learned from the 1998 crisis, where countries in Indonesia, like Indonesia and Malaysia and all that, had issued bonds. Some of them in foreign currencies like the USD, and then they over leveraged themselves, and they when their currencies declined substantially against the USD, their costs of retaining interest goes up. Now, I'll give you an example. HDFC Bank issued a bond, 81 bond. Of course, it does not return it, but assume it's a bond. Um, uh, at when the rupee was 75 to a dollar, and it issued it at an interest rate of 3%. But now the dollar has gone to 82 or 81.5. So you've had a nearly 6, 7, 8% depreciation in the rupee. So if they had to return that bond, they would have to return not only the 3% extra in USD that they have to make for the USD return itself, but also the extra 7.5, 8% that their rupee has depreciated. So their cost of that fund has gone to 11%. Now imagine a country whose currency depreciated 30, 40%. That country's borrowing would have to return 30, 40% more in local currency terms, and that will render a lot of companies in the mercy of their debtors. So that's what has happened already in a few countries, and I think is something that the RBI has been not very keen about. So we've not allowed foreigners to own our debt for a long time. So um, because of that, foreigners have said, listen, we have global bond indexes, but because you don't allow us to own your debt, we're not going to include you in them. And we're like, we don't care. We don't include us. I don't want to do dhanda with you on bond. I will do dhanda with you on equity. So equity you buy as much as you want, but bonds no. Recently, bond yields have gone down worldwide, and that's because of global money flowing into index funds linked to bond indices. And this is from pensions, institutions, even retail investors who have put in money in different parts of the world to invest in bond indexes, some global developed market indexes and some global emerging market indexes. Now, the emerging market index is quite huge, and some India is not included in that, in the global emerging market indexes or global world bond indexes, because they can't own our debt. Now, over time, India said, well, it may be okay for them to own some debt. So over time, they've kind of eased the rules. The rules earlier were, oh, you had to do this complex registration process. So they started to create single window registration for a lot of things. They have, uh, uh, for about 3 years ago, they instituted a new set of rules that said, well, foreign investors can't own bonds that mature within 3 years of the time that is purchased. So if I buy a bond today, it has to mature 3 years from now. That's residual maturity of 3 years at least, and they therefore couldn't access any bond uh, which was less than 3 years from issuance. So, if the government of India issues a bond that matures in 2024 today, a foreign investor couldn't buy it. It was not allowed. Now, because of that, the short-term bond was simply not available to foreign investors. So this was something that they said, okay, let's do something called a fully accessible route. And oh, by the way, there was another thing that they eased up this rule by saying 30, if you could buy some short term bonds as long as those bonds are only 30% of your portfolio, which means you have to own 70% long term bonds, 30% short term. So if you want to buy $1 million worth of short term bonds, you should have, you know into about two and a half, so about $3 million roughly worth of long term bonds in order to just purchase the short term bond. So you couldn't just be a short term bond player at all. So last year they started to change the rules. They said, well, we'll allow some bonds, some government bonds, which are denominated in rupees only. So there is no dollar risk to give to foreigners at a certain. I mean, they could buy as much as they want. They could buy. There's none of this 10%, 30% wala limits that apply. And the number of bonds that have qualified for this are fairly large now. So from 2024 maturity all the way till 2050 maturity, there's lots of bonds now that qualify for this fully accessible route called FAR. The This allows India to now start getting included in bond indexes. However, India has some complex set of rules around taxation. For instance, every bond that is bought in India by a foreigner, they have to pay 5% uh, TDS in India, and I think the bond is taxable in India or something like that, which is different because, sorry, the interest is taxable in India. That's true across all countries, but the capital gains is also taxable in India, which is not true for uh, a company in the US, for instance, a bond in the US that's bought by, say, investors in the UK. The UK will pay capital gains only to the UK because they're domiciled in the UK. They're buying a US bond. The US does not tax foreign investors on capital gains. India taxes foreign investors on capital gains, equity or debt. So the debt investors didn't like the bond index makers didn't like that as much because this taxation is unfavorable and it's only one country they say. But I know that there are other countries who have such laws which are included in bond indexes. So it's not really a criteria, but that's one of the criteria they've used to say India shouldn't be a part of it. Another one is the complex registration procedures, the longer period of holding requirement, and all sorts of smaller things that they've said. Why will this help us? So, if you look at the Indian government borrowing, our deficits are very huge. So, we run maybe at 15 lakh crore deficit. We spend 15 lakh crores more than we earn. The government does. They have to finance it through two mechanisms. One is through the bond market, and one is through small savings, your PPF, NSC, and all of that stuff. The PPF, NSC, etc. Have given returns of have actually contributed to something like 4 lakh crores in the last few years of additional investments every year from people who go to either post offices and buy it and all that. The remaining 11 to 12 lakh crores is borrowed from the bond markets. Now, our bond markets are also not very deep. Our domestic investors like banks and pension funds and mutual funds and insurance companies, these are the ones that buy government bonds, and they're the only ones who can buy because the foreign investors are small players in this whole thing, right? So they end up with a situation where the government is largely at the mercy of banks in terms of interest costs. So India pays a very high interest cost, even though it is Indian government bonds are very safe. To give you an example, today HDFC Bank's deposit rate for 3 years is probably around 6.4 or 6.5%. They haven't increased deposit rates. The government bond for the same time, and the government is definitely safer than HDFC Bank. So you're getting a safer bond from the government and the government is paying 7.5% or 7.43%, let's say. The 7.3%, you're paying a higher interest rate to the government is paying a higher interest rate than a bank from despite being safer. That's because of the vagaries of the market, the borrowing, this thing. There's not enough players. There's a lot of supply, not enough demand, and that not enough demand comes from the fact that it's the institutional players are not deep enough and rich enough to be able to buy these. To give you an example, a lot of you are live in apartments. Apartments have housing associations. The housing associations have a corpus. That corpus fund, the rules are today that these corpus funds can only be invested in fixed deposits. Many states have different rules, but you can't buy equities or even sometimes bonds with this thing. You can't even buy government bonds, even though government bonds are safer than fixed deposits. You can't buy these places can't buy government bonds. So our institutional market is very weak. To bring in more depth into it, it will require a change of rules of associations and all that stuff. That's a different part of the game. But the part of the game that's most interesting will be foreign players that can come in. If the foreign capital comes in, they will buy government bonds. Now, why is government bonds important? If government bonds are the safest bonds on the planet, so or for Indian rupees, right? So the Indian rupee government will never default on rupee bonds. So if the safest bonds are getting lower in because more demand than supply, then the yields, the interest rates required to be paid by the government will come down. If they come down, then banks which currently keep a lot of money in government bonds need not keep as much money in government bonds and can actually lend to other people. So the government does not crowd out investments of bond players in the bond market and frees up money for credit. This is the traditional thinking. Of course, the real activity is very different, but that is the way, that is the reason why India wants foreign investors to come into Indian bond markets is simply that. I think the 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 concept becomes this, and we, right now we're not getting in. I think the not getting in is actually a political move, not a economic move. All these excuses seem to be too flimsy to allow us to come in, because if you do this, India, by the way, our largest single expense in our budget, largest by a factor of maybe, because the next expense is like 40% lower than this. The largest expense is interest cost. That means we spend about 35 lakh crores a year, and out of which 7 to 8 lakh crores a year is just interest on the bonds that we already issued. If we were to reduce our interest costs, the government would have a lot more money left for other things, and our budget would not have, or either that or the budget would have not have such a deep deficit. Both ways, good for bonds, good for the country, good for the economy, good for credit. But this bond market thing is this bond market inclusion is probably still a year or two away until the politics is solved. I hope that's all. That's a very long answer. I'm sorry.
No, thank you so much. That was like a lot of context actually. Um, I want to ask just one other question, and this one is a little ill-framed or like not specific enough. But one thing I've always wondered about is that if you look at the structure of the economy, it's like a self-fulfilling prophecy in the sense that the people that don't have jobs and who have a degree, they want work, and the entrepreneur also wants that, right? So what is the rate limiting step, or the rate determining step in determining like what is the true GDP growth of a country, basically? Like, why is it that India grows at, let's say, this 5-6% and not 10%? Like, do we know about like what is the reason for a low growth in India versus, if you compare it to China, which has grown at much faster rates historically?
So I don't necessarily know the answer to this, and I can only give my thoughts around it. So I'm not. I mean, I don't have the data to back this up. But my feeling longer term is that the GDP of India for a long time was fairly inaccurately measured, in the sense that you had a lot of you had a lot of people that were in the informal part of the educational process, all of which resulted in basically, because if you had an informal part of the GDP, you couldn't measure that certain transactions that were happening in the first place, and the transactions where additional value was being created, we were not able to see them in any meaningful way, impact GDP. So one was that as well, but that's no longer probably there. We've got GDP, we've got much better assessment given the GST, and a lot more formalization of the economy has happened. The second part is, uh, you know, you'll always have a certain part of unemployment, and you'll always have a certain part of demand from the employers, which says, well, I can't find enough people. And one of the biggest reasons for this to coexist at the same time, is the skill gap. So you have jobs which need people who have a certain skill, and the skill is not quite readily available. And are to bridge that, you're going to need a lot of spending on education. The spending on education is not necessarily happening from the government, in fact not at all happening from the government at all, I mean, in any meaningful way. And there is also the additional healthcare infrastructure that you need to ensure that people are healthy enough to be able to partake of those skills or learn those skills. And the healthcare investments, now actually they've happened to a certain extent, but these are long range, so the impacts will be felt uh, over a longer period of time than now. So one is, I think the skill gap has to kind of be addressed at some level, and the formalization of the economy itself will require a lot. I think here the cost of capital has made a big difference. India has a very high cost of capital. So you typically, if you consider China, they've kept their cost of capital relatively low, and inflation, of course, has been controlled in their economy. So even though we have controlled inflation to a certain extent, our interest rates remain high, and capital, like entrepreneurs today, pay a significantly higher rate of interest than even the cost of capital that you see. So 10-11% is probably the minimum that they pay on a lot of loans. Small entrepreneurs end up paying something like 15 or 16%, even to the banking system or to microfinanciers. And because of that, the cost, the return on capital requirements tend to be very high. So you because of that, you end up with a lot of businesses that simply don't make sense, and therefore GDP growth suffers, because a lot of businesses will just not happen. A lot of business. Look at great tourist places in India. You simply don't have tourist infrastructure that caters to even the demand that comes. And when times like this happen, where people want to go to places, they discover places on the internet and they want to go there, there is simply no one available, or not enough facilities, not enough. Maybe it is hotels, maybe it is shops, maybe it is areas. None of that is available to investors who, people who tourists who go to certain places. And that's lack of infrastructure, simply because the entrepreneur is there, but the capital isn't. And to me, I think that is one of the reasons which holds us back from larger GDP growth. That's a higher cost of capital, and skill gap. So once the way other countries address skill gaps are, they import people. So they allow visas, work visas. India doesn't do that at all. So we don't encourage it. We don't have a great educational system that allows for a research oriented approach, or the education in India is very commercial in nature. It's not so much research oriented, or so you don't get a lot of great people coming to India to study and then go on to work here, and so on. So importing for the skill gap is not something we do, and that also has its own sets of challenges. And um, um, you know it affects GDP growth in some kind of way, because you don't have the skill. Uh, all said, I'm still positive. I think longer term we should be able to address these issues, And perhaps the bond market question is relevant to more of this capital, high cost of capital thing, because if you reduce what governments pay, you will reduce what private people pay as well. But it will take time. That's what I think.
Thank you so much, Deepak sir. Take care. Bye.
Thanks, Sahil.
Yep, I'm here, and apparently we are not able to get any requests in because Twitter is acting up. So I'm getting DMs from people that they are not able to uh, share their request. So maybe you could DM me your question and I can ask. Unless Deepak, you would want to end the space because it's more than an hour, I think.
Sorry, I'm good. I'm just in the world's worst traffic jam, so I'm happy to to answer these questions, I guess.
So in short, you're in Bangalore. So,
Yeah, in Bangalore is like the world's greatest traffic jam right now, I think. But,
right.
but
Before we get any other request, I'll take a question from the comment section in on your Twitter. So the question from Ketan is that from 2020 fall till now, ignoring the COVID phase completely, what difference is there in the economy from March 2020 that is driving the markets?
it's positively not there, no. I think uh, we don't have a great difference from the pure base economy. In fact, in dollar terms, I think our per capita GDP has actually declined from pre 2020 to now. I'm not sure about now. We don't have exact figures, but uh, the economy as a whole has probably contracted so much in 2020 2021 that it will probably take till the end of this financial year just to make up some or all of it. So on real basis, not post inflation, we're higher. So um, uh, real basis, we're probably lower. But what has changed, with the economy not moving up, I think it's largely so the rich have gotten richer, the poor have gotten poorer. So the rich are relatively smaller number wise percentage of the economy, but they're a much larger GDP percentage wise of the economy. So while the rich have gotten richer, therefore income taxes have grown. Income taxes are only paid by the rich because up till about 6.5 lakh rupees, I think you don't even have to pay income tax. And the poor have gotten poorer. You see a lot of entrepreneurs, shut shop and not being able to open back again. A lot of restaurants went out of business permanently. A lot of smaller, businesses very deeply impacted. So I would say, maybe that's why the GDP hasn't gone that well, but stock markets have.
Okay, and next question. So we have a set of questions where people are asking your views on FMCG, pharma, and other sectors. So I'll just combine those in one question. Although we can't talk about specific stocks, but which sectors or segments look interesting to you and something that you're tracking or anything you want to share about anything that pops out.
Wow. Okay. So I don't know much about all the sectors that you know. So all the sectors that will do well going forward, but you see the momentum in stocks seem to all be in a few sectors. Pharma, for instance, Cipla making an all-time high, Sun Pharma getting up there. There seems to be some interest over there. There is some interest in certain auto stocks, which seem to be hitting or are close to all-time highs. The others aren't doing well, so it's very segregated in auto. There is some interest in the defense sector. So almost all players are probably celebrating the move to source more defense products from India rather than abroad. A process that was started a few years ago, but probably is taking on more and more action now. Um, there is also there. I mean, these are the positive-looking sectors. Even IT, after all this fall, is likely to start benefiting because now prices are in much better shape than compared to earlier, and we have a different. um a different set of challenges going forward, but different set of opportunities also for IT, because once the recessions or whatever is happening in the West kind of settle down, I think outsourcing will increase. So my but these core theories all are so data dependent that um, anything that in the future affects us. For instance, if the FDA got extremely active and they've already started to send warning letters and some things and EIRs and all that to Indian companies. If this thing gets complicated, if there are more and more such complications that happen in the equity in the equity markets, I mean, or in stocks, then the pharma rise will get curtailed almost on its own. So you have to be careful that the data doesn't say anything. But by and large, if you're looking at 4 or 5 years, I think in India a lot of the banks will do well. A lot of IT companies will do really well. I do think that some of the new retail consumer plays uh, that seem expensive right now will still do well from a growth perspective if they're all able to achieve 25-30% growth like they seem to. Then even their high PEs will eventually end up getting justified, if you may, over a period of time. So you might end up with some good stocks even from here. But at best, what I would say is, you have to literally thank your stars every day that we haven't had a deep correction as deep as the West in many places. And let's hope that if the next piece of the puzzle, which is what happens when rates actually go up and are increased in the West and trickle down to the Western economy, if that time also we don't have too much of a deep downturn, then we should be out of this without too much damage from here. Um, I'm still positive on pretty much all of these sectors in the long term, but in the short term, I think we will see damage in many of them.
Moving on, Deepak. So there's one more question. So this I'm going to get stock specific, so you can choose to answer and whatever we would want to. So the question from Akash is, what is the reason for underperformance of Kotak and HDFC Bank? And I'll add a corollary here that why there is so much love given to ICICI Bank.
Sorry, what is the thing? What is the corollary?
The corollary is that why is there so much love being given to ICICI Bank and the other two are underperforming?
Yeah, this is like, one of those eternal. I don't know if you had to make a film movie about this. This is one people loving one bank, and then stopping loving one bank and loving another bank, and then stopping loving it and going to the third bank and all that. There was a time in which every day you would find out that Kotak is acquiring X or Y or Z. There was so much love for Kotak. Then there was a love for HDFC Bank because, HDFC Bank can do no wrong, and therefore HDFC Bank is all sorts of awesome. And then you have, today when ICICI is the love of the banking life, and it is not HDFC and Kotak. So I think these are like, I mean, ICICI is just a more bigger corporate entity than corporate focused bank than HDFC was. HDFC is now slowly becoming more corporate oriented. It's not fully anywhere close to it, but it's and recently also today's announcement. It actually had much higher growth in the corporate and small business loan credit than it had in retail loans. So its traditional base of retail loans is probably slowly getting secularized into other stuff as well. Kotak by itself is much more than a bank. It is a bank. It owns the AMC. It owns an insurance company. It owns, and all of this valuation sits in the bank itself. It does not, diluted. ICICI on the other hand, the securities arm is listed separately. The insurance arms are listed separately, and so on. So that way, and HDFC Bank does, until it merges with HDFC, does not have any ownership of these businesses. So to an extent, I think HDFC bank is hampered by what people think will happen due to its larger due to its merge with HDFC, and the uncertainties regarding how index funds will have to deal with the merger whenever it happens and all that stuff. So once those uncertainties go away, you might see a much better return profile in the stock as well. But they've done fairly well. So I won't say that these stocks are bad. Fundamentally, they seem to be okay. They just seem to have lost quite, not quite gotten the love recently. But you know what? 1 year later, we'll be talking about why Kotak and not ICICI. So वो तो एक थोड़ा सा fight ही है.
Right. So next question is a little global. No, it's fully global. So K Kumar is asking, what is the probability of Fed pivoting in the short term?
I think zero. I don't think they're going to pivot. So I'll be wrong. I'm happy to be wrong here. I'm happy because if they're wrong, then the markets will go up. And if I'm right, I get to say I'm right. So I'm hedged both ways. So the issue that I would say here is why is the Fed raising interest rates? Because there's too much inflation. If the Fed is raising rates because there's too much inflation, then why will it suddenly stop raising rates when there is too much inflation? They will wait for inflation to come down. They will wait for unemployment to rise. And one of the reasons why the market's so high up today is possibly because one of the factors that might indicate that unemployment is rising is a data point that came out today. So that data point is like, oh, people are like, oh my God, because of this, maybe the Fed will pivot. But I don't think they'll pivot until they see both inflation come down and unemployment slash wages correct. So from where they are, so unemployment is at an all-time low. That is 4% or something. That point is still a while away, and the Fed doesn't have to care about what their actions do to other countries. They can do whatever they want to their own country. Other countries can go, jump if they want to. So the Fed is not responsible for them. So I think the Fed will pivot just because
Okay.
some UK fund is crashing.
Right. So before we move forward, anybody who would have a question, they could just raise their hand or a request and we'll put them on. And if you can't seem to put in your request, there's a chat icon at the bottom right of your screen. Press that and post your question in the comment section. I'll take it up. There's a nice interesting
Last three
question.
questions.
So
थोड़ा सा फिर long fight हो जाएगा. 3 questions ले
okay.
लेते हैं.
So last three questions. So one question I have already selected. Somebody is asking which car are you driving? There is so good noise cancellation. So would you want to take that up?
It's the mute button. That's the noise cancellation. And by the way, it's a Maruti S Cross, so it's an awesome car. Okay, but it's the diesel version, and it's we've gone through some crazy bumps along the way. I don't know if you heard them, but there was. It's been bumpy all the way because we've had to take some kind of crazy roads to come here. Pretty awesome side roads. I mean, and awesome in the sense of in Bangalore, if you have a road, it's awesome. So the, the fact that I've actually gotten to somewhere is quite some thing, but that's the course.
Okay, so that's one. So second question, Deepak, is can you explain? So explain will be a long thing, but can you give your views on the recent action by Bank of England to bring the bond buying and liquidity infusion, plus what the issues with the pension funds in UK? So I think for that on issues with pension funds in UK, there was a great newsletter by Matt Levin. So I would before you answer, I'll just point to that, and that is a great explanation of what went wrong there. But on your views on the whole Bank of England and UK scenario.
Okay, so I'll give you the core 5 minute thesis. I should write about this, but okay, Pat Levin's done a much better job. But let me tell you what the core situation is. England is screwed. England is going Brexit. England is facing challenges with inflation. England is facing challenges with growth. So England elects new whatever they call them. I don't know what it's a prime minister or whatever it is. That person comes in and says, "Well, you know what? We will bring back the economy by A, spending more, and B, lowering taxes." If you do things like this, you have a problem because you now will earn less because you're reducing taxes, and you will spend more because you're spending more, which means you will increase your deficit. How do you finance the deficit? You finance it through the bond market. Your bond market people are not stupid enough to say, I will give you money at the same interest rate as before when you're borrowing more money. So they will say, I want a higher interest rate. Then they say they want a higher interest rates, yields in the market go up. If yields in the market, bond market go up, the Bank of England starts seeing higher yields for government securities or gilts, which are longer term in nature. So 30-year gilts are at 5%, and 10-year gilts are at 4%, and so on. That's what happened a few days back. This resulted in a very weird phenomenon because of what pension funds in the UK suddenly started doing, because they were all like me, engineers who have become finance players, and therefore wanted to introduce math into everything, which is where it's not supposed to be introduced. So one of the math things that they did was that they told pension funds that, listen, if you have something that gives you 3%, then you project into the future that you have to pay certain pensions, because they are defined benefit pensions. You have to pay a certain amount of pension every year for the next 3 years, next 4 years, next 5 years, and next 30 years, all the way to 30 years. If you calculate using complex mathematics how much you need to pay, then you need, you can buy bonds worth 8%, yielding 8%, and everything will be well. That sounds good. Not very complex mathematics here, but very decent. You just buy bonds and sit. But what if the bond yields start falling down? Now you have a very weirdo problem, is because the mathematical guys who did this stuff said we will take the present value of all the liabilities, which means if you're getting 8% in the bonds, then something that I have to pay out 10 years from now, it's 100 rupees, I will discount it to the current date, assuming 8% is what is available. So what at 8%, what will grow to become 100 rupees in 2032? It's a 10-year, it's a mathematical formula. You can say it is 50 rupees. So if it is 50 rupees today, it will grow to 100 rupees in 2032. So whatever I have to pay out as 100 rupees in 32 is actually worth 50 rupees today. That's my liability in today's currency. It also means that I have to have assets worth 50 rupees today. So whatever assets I have is supposed to be worth 50 rupees, and so on. When yields in the market, which what happened, went down, the discount rate, which was 8%, went down to 4% or 3% or whatever. So this 50 rupee liability in the same calculation mechanism became 75 rupees. Now I need 70 rupees of assets to match my pension liabilities because of the same calculation. Unfortunately, I had 50 rupees of assets yesterday. You reduce interest rates. Now I need 75 rupees of assets. How do I get it? I can't get it. And so I am underfunded. So then if I am a pension fund manager, I go to people and say, this is the, I am underfunded by $25, 25 rupees. You'll say, boss, you lose job. I'll find different pension fund manager who cannot be so badly underfunded. So answer to solution, people turn to mathematics and say, how can I solve this? You say, oh, well, you know what, instead of buying 50 rupees worth bonds, why don't you buy 150 rupees worth bonds or something like that? Take the leverage on this thing, and then you pay some, I mean, effectively there is some interest rate offset and all that stuff, and your assets will be worth 75 rupees today. So I say, well, fine, I keep my job, I'll do this, and we'll call it a nice name called LDI, liability driven investing or something like that. Effectively, they took loans. Effectively, I say, it's not a loan, but it's a complex mechanism like a fixed to floating swap or something like that. But essentially, what it means is, if interest rates were to ever go up, this fund, which has largely pension fund, which has largely should have been boring old 100 rupees of assets meet 100 rupees of liabilities, because of mathematical rigmarole, has resulted in a situation where they are leveraged, and when yields go up, the bond prices fall, and when the bond prices fall, they have bet on the same bond prices in a leveraged manner, effectively 3x of capital or 2x of capital, and so on. And that leverage means that, like in the futures market, if your stock goes up 5%, you may actually have to increase your margin by 20%, because the margin costs are you only put, say, 20% of the total futures value as a margin in the first place. So mark to market increases, and it increases at a substantially higher rate. So bond yields go up 1%, your bond prices fall 7%. But because you're leveraged, you have a 20% additional margin that you have to give to to the broker that effectively manages all of this. And because of requirements also. So they were technically bankrupt for a while until the Bank of England came in and said, dude, we can't do all of this drama. We will buy bonds and reduce the prices so that your margin calls are not so bad and so on. So this is what has happened. They are going to be buying bonds for the next 11 days. After that, I don't know what will happen because everybody knows the problem is 5%. At 5%, you're finished. So we will wait for October 14th. After that, we will take bond yields to 5% again and see how much more damage it causes. That's how markets are. Markets are vultures waiting at the seams. So the story is not over, but it looks today like it's over, but it's not. So we should expect a lot more drama to happen in the next few months.
Okay, so Deepak, last question for the day, and incidentally, it's a follow up to what we just talked about. So Naresh Shenoy is asking that if pension funds depend on new people contributing to keep paying out the retirees, how is it different from a Ponzi scheme?
Almost everything in finance is at some level a Ponzi scheme. So are government bonds because governments largely run deficits. So every time they have to borrow new money to pay back old money and interest also. So that way, yes, of course, everything is a Ponzi scheme. So once a Ponzi scheme is something that's not run by a government or a pension fund. Uh, that is Ponzi. So I think that may be a better definition of a Ponzi scheme. But that way, the only difference between a pension fund is that a pension fund can be run without needing new investors to invest. That if you have pension assets that can meet your liabilities over time, and let's say you think people will live on till 90, and that assumption doesn't hold good. Say they live only till they're 85, you might still be able to meet those investments. So I think the concept of these investments, pension funds being Ponzi, are sometimes structural problem, and sometimes a problem that is only temporary and will get cured as more and more people come in and assets build up over time as well.
Great. So I think Deepak, that on that note, I think we should conclude the space. So I'll
Yes.
leave it to you for your final thoughts, and then you can close the space. So bye from my side.
Cool. Thanks so much, Nihit. It's a long, long day, so I won't take too much. But thanks so much. This was a great space. I am sorry we couldn't accommodate all the requests. Some Twitter thing keeps happening all the time. And I have reached my house, so this is also a great time to end. Thanks and good evening to everyone. We'll do more of these random spaces and some more organized spaces as well. This is recorded, so you can always come back and check it out. We'll have more for you. So please let us know in comments. Visit capitalmind.in or come to our Kya Lagta Hai on Fridays, which will keep uh, happening. Thanks so much. And I'll close the show now. I hope you have a good evening and good Dashera. Have fun, all of you.